still letting these bigger patterns play out, which is around $40 for silver. It's also about 3,600, potentially 3,300 for gold. This 618, which is known as the golden ratio. And when price comes down and tests this level, and then potentially pauses there, we almost always see the price continue all the way down to the 100% measured move. If it has a series of lower highs, if it has a series of lower lows, that is the definition of a downtrend. It's channeling lower, right? So I believe gold and silver are in a bear market. They've both corrected well more, a lot over 20%. It's finding short-term support. Each time it tests it, it's going to be eating up some of that supply, and then eventually it is probably going to resolve to the downside. It can still trade through it, it can still drop sharply below it. Silver is very volatile, as we know, so it generally will have very long wicks. So even if it was to come down to 50, who knows? It could have like an intraday or an intra-week swing where
precious metals have continued to break down. Silver going to about $55, now bouncing a bit. You mentioned, I guess, where do you see us going from here? Because I know last time we had you on, you were saying silver could go as low as $40. What are the charts showing you right now?
Yeah, well, the charts I'm looking at, the time frames haven't changed. I still have the same targets. We're still letting these bigger patterns play out, which is around $40 for silver. It's also about 3,600, potentially 3,300 for gold. So there's still quite a bit of downside left, but it seems everybody's getting really bullish at this moment. Just the way the charts are kind of setting up, and from some standpoints, some people are thinking, it's found support, the metals space. But overall, I mean, we're still seeing weakness, and there's weakness in other areas that are going to bleed over potentially into the precious metals space, like the equities market. If selling starts there, it's going to put pressure on metals. If we see the dollar start a new leg higher, that's going to put pressure on. So there's a lot of downward bias, a lot of things pointing that's going to put a lot of headwinds for metals for sure.
And did you want to share the chart of silver, where you're getting that $40 target from?
Yeah, if we take a look at the daily chart of silver, really we've had a initial huge the bubble kind of burst initially, this huge drop, and that's kind of the first leg down. And
retail optimism often peaks precisely when downside risk is quietly expanding beneath the surface. Chris Vermeulen notes that silver near $55 could still be only the midpoint of a broader technical decline, not the end of it. While headlines celebrate resilience, strengthening dollar momentum and fragile equity markets could create forced selling that ignores bullish narratives. Investors protecting long-term wealth should prepare for volatility instead of assuming every bounce marks a lasting bottom. Next, Chris Vermeulen reveals why today's strongest support level may become tomorrow's biggest trap.
I like to use what I call, or what's called, Fibonacci extensions. This is using Fibonacci theory. If listeners don't know what it is, definitely go look it up. I actually did a video about Fibonacci theory online, but more or less it's telling us, based on the momentum of this initial drop and the strength of the bounce, is going to tell us kind of what the momentum and the strength and where the next downside targets are for silver. So if we were to just use this as the analysis, we have, again, the initial sell-off in price, then we had the bounce. And the way Fibonacci theory works, I find, for the most accurate move is this 618, which is known as the golden ratio. And when price comes down and tests this level, and then potentially pauses there, we almost always see the price continue all the way down to the 100% measured move. So that's more or less saying the size of this drop is going to happen again once it's had this correction. And so that is the second half of this drop. So it is pointing to about $39, $40 per ounce in silver. Now, a lot of people are seeing silver as potentially bottoming here. People are saying it's bottomed, it's put in a double bottom. This is a significant pivot zone on the chart. I mean, if you kind of drag this across these levels, it is definitely a support level, a short-term support level for silver. But overall, the trend is down.
Markets often pause at famous chart levels before making their most decisive move. According to Chris Vermeulen, Fibonacci extensions suggest that a temporary bounce near key support does not automatically invalidate a larger bearish structure. History shows technical pauses frequently lure buyers just before momentum resumes in the prevailing direction, catching late entrants off guard. Long-term investors should separate emotional confidence from disciplined probability when evaluating precious metals today. Next, Chris Vermeulen exposes why the apparent double bottom could conceal a far larger technical breakdown.
The really easiest way to get an idea, there's two easy ways to identify the trend and what likely is going to happen with any asset class. The first one is if it has a series of lower highs, if it has a series of lower lows, that is the definition of a downtrend. It's channeling lower, right? So the odds are a trend is going to continue than it is to reverse. So just based on falling price alone, it's telling us that this pause right here is actually probably seen as a bear flag pattern, and we're going to see another move down. The other really, really simple way to identify kind of the overall trend is simply look at the moving averages. When we look at the moving averages, we've got the long-term 150-day moving average sloping down. Typically, if it is sloping down and prices below it, you're in a bear market. And so I believe gold and silver are in a bear market. They've both corrected well more, a lot over 20%. We've got the 50-day moving average, which is the intermediate trend. We got the 20-day moving average sloping down. We got the 5-day layered below it. So everything on the silver chart is saying, hey, the trend is likely going to continue to go lower, and that's both long-term and short-term. So, people are kind of a little bit excited here because people are thinking it's putting in a double bottom. It's kind of at this breakout zone. But again, when you look at the trends and step back, this is really just at this point a technical bounce.
The costliest investing mistake is confusing a temporary bounce with a lasting recovery. What Chris Vermeulen is highlighting is that lower highs, lower lows, and declining moving averages all reinforce the same bearish message across multiple timeframes. Media narratives often celebrate isolated rebounds, while ignoring broader trend deterioration that institutions monitor closely. Preserving capital sometimes means waiting patiently instead of forcing optimistic trades. Next, Chris Vermeulen unravels why psychological support levels rarely stop institutional liquidation.
It's finding short-term support. Each time it tests it, it's going to be eating up some of that supply, and then eventually it is probably going to resolve to the downside.
No, the $40 mark you get from that Fibonacci number there, which I think is quite interesting. A lot of people are putting numbers, for example, like at 50. It can't go below 50 because it's psychologically so important given the 1980s high and the 2011 high and how we kind of stalled out there last year. Do you see that as being credible at all, or do you really more anticipate those Fibonacci numbers coming to fruition?
Well, there's no doubt there's some merit to it. Like if we come and we look at silver here for the $50 mark, it's a whole number. As you and I have talked before, usually if you're above a whole number and your drop price is falling towards it, people are naturally going to be like, hey, I'm going to buy it at $50. That's going to be a great deal. There's something about decade numbers, so $40, $50, $60, and whatever side you're on of that, if price is above it and falling, there's going to be natural people wanting to buy around that $50 mark. It's just that psychological level. It is obviously a critical high that was done back in 2011, but it doesn't mean it's going to hit that to the T and then just take off. It can still trade through it. It can still drop sharply below it. Silver is very volatile, as we know.
Psychological price levels comfort investors far more than markets ever promise to respect them. Chris Vermeulen's argument suggests that round numbers attract buyers precisely because human behavior clusters around familiar milestones, not because markets must reverse there. Large institutions understand this tendency and often exploit concentrated liquidity during volatile declines. Blind confidence in historical support can become an expensive lesson when fear overtakes conviction. Next, Chris Vermeulen reveals why volatility itself may become the biggest weapon against impatient investors.
So it generally will have very long wicks. So even if it was to come down to 50, who knows? It could have like an intraday or an intra-week swing where it drops all the way down to 40 or dips below it and then rallies back by the end of the bar and closes at 50. And people will be like, oh, 50 held up. But I mean, nothing is that perfect, right? You have to expect a lot of wiggle room in silver. It could fluctuate probably $10 below that easily. But overall, it will most likely be a technical bounce. When silver comes down to the $50 mark, potentially over the next few sessions or over the next couple of weeks, there's no doubt you watch the intraday chart, you'll probably see on the order books, you'll probably see a big stack of people wanting to buy ounces and buy, contracts at that level. The question is, can it hold, right? It's just a technical bounce. It's not actually, I don't think it's going to be a solid support level.
Now, as for gold, what are you seeing for the numbers there? It sounds like you were saying it could go as low as 3,300.
Yeah, so gold has done a few different levels. It initially had its first big drop and its bounce, and then it had its next measured move. So, I mean, we can just draw this out. We had the initial drop, and then we had the bounce. And as you can see here, let me just draw on the chart and zoom in a little bit because this is important.
Heavy buying at obvious price levels rarely guarantees institutional confidence. This is where Chris Vermeulen's thesis shifts from identifying support to questioning whether that support can survive professional selling pressure. Smart money often waits for retail enthusiasm to absorb supply before momentum resumes in the prevailing direction. Investors should judge price behavior after support breaks, not before it is tested. Next, Chris Vermeulen exposes why gold's next measured move could matter more than silver's temporary rebound.
We saw the initial drop, and then we had the bounce, and then we came down, we pierced right through the 618 level. It just continued to free fall, and it did obviously have a big wick through it, but it came down, hit the 100% measured move level, and then started to bounce. So that initial drop that silver is still working on, gold has already completed that. And so now we have to look at the next move for gold. And so the next move for gold is the next series high. Is this high? It's followed by the big sell-off, and then the bounce. And if we just kind of carry that forward to where we are now, you can see those levels. We are at the 618 level. As I mentioned before, if you hit this level and there's a hiccup or a pause on the chart, usually we're going to see price unfold and fall down to this 100% measured move, which is about $3,500, $3,600 per ounce. So there's still some pretty good downside potential in both gold and silver. And I do feel like if they actually hit those levels, I think it's going to create a lot of panic selling. There's going to be a lot of fear. I don't think a lot of people are expecting gold and silver to break down here. I mean, there's a lot of people betting and stacking right now as saying that, it's turned a corner and things like that. So overall, this is where we could start to see a very sharp drop and then actually see some panic selling.
The most dangerous declines usually begin while investors still believe the worst has already passed. Chris Vermeulen notes that gold may be following a measured pattern toward deeper downside despite widespread expectations of recovery. Panic rarely starts at the lows. It accelerates only after confidence finally breaks. Protecting wealth means preparing emotionally before volatility forces rushed decisions. Next, Chris Vermeulen reveals why fear itself could become the final catalyst behind precious metals washout.
And even if, gold comes down to 3,500, it might have a huge, intraday move or throughout the week have a huge washout low and then maybe recover back. So I'm expecting a lot of volatility in the precious metal space, which I think is a great opportunity. It's going to cleanse the market, get us down to some critical, I think, fair value levels for where we can move into precious metals for a long-term position.
What do you anticipate in the coming weeks or months will be the catalyst for this washout in the metals?
Well, there'll probably be some type of news, right? There'll be something. And the charts are already telling us, I think chaos is kind of coming. One of them is the equities market is starting to top. Like when we look at the QQQ, which is the NASDAQ 100, it's starting to roll over. We're seeing the AI start to lose some of its bubble, its steam. When we look at the markets from a technical standpoint, so this is the QQQ daily chart, you can see we had a trend reversal on our trend signal chart. It's rallied over. Now it's starting to lose its momentum. When we look at the actual sentiment chart here on the right-hand chart, we're starting to get red bars saying, hey, this trend is coming to an end. The internals are breaking down. Money, big money, is starting to flow away from the equities market. And so this is an early warning sign. We need to be aware. The markets are close to breaking down. And
major reversals rarely arrive without warning. Investors usually ignore the signals until headlines confirm them. According to Chris Vermeulen, weakening market internals and fading momentum suggest risk appetite is quietly deteriorating beneath record valuations. If institutional money continues rotating away from equities, precious metals may initially suffer alongside broader liquidation. Patient investors should watch capital flows, not emotional forecasts. Next, Chris Vermeulen exposes why stock market weakness could temporarily undermine gold's safe haven reputation.
if the stock market breaks down, that selling pressure is going to trigger probably a lot more selling in gold. Even though gold has got the perfect fundamental story, it doesn't matter. When there is blood on the streets, when we see panic selling in the stock market, there's margin calls, people will sell what is even a good position. They'll have to dump or they'll just be fearful. They'll just get rid of gold and silver. And so that's kind of what we need to be aware of. And the stock market here is just really starting to struggle. The other big thing, Elijah, is the US dollar. When we zoom in here on the US dollar, we've had this initial big bottom. You and I have talked about this many times. This is a level we've been looking at for a long time as a breakout out of this rounding base, the stage one kind of basing formation for the dollar. And now the dollar it's doing exactly the opposite of what precious metals are doing. It has a series of higher lows and a series of higher highs. That's the definition of a downtrend. It's broken significant pivot highs, is broken out of this rounding formation, and it's pointing to much higher pricing. And the dollar strengthening is telling us, I think there's kind of some big global concerns going on. Something big is about to unwind. We're probably going to see the US dollar start to skyrocket, which is going to put pressure on the on metals in general. And of course, the equities market will sell off. So there's a lot of things coming together. Again,
the strongest safe haven story can still decline when investors are forced to raise cash. What Chris Vermeulen is highlighting is that a rising dollar and market-wide liquidation can overwhelm gold's bullish fundamentals in the short term. Margin calls create indiscriminate selling that ignores long-term value and rewards liquidity above conviction. Wealth preservation depends on understanding market mechanics, not trusting comforting narratives. Next, Chris Vermeulen unravels why a stronger dollar may signal deeper global stress than policymakers admit.
And we've got the dollar here starting what looks to be a new bull market. This is long-term trend stuff. We have both gold, silver, and miners all actually turning into a new bear market. They have the long-term trends down. They're breaking down on all time frames. So this is huge. This is very big. A lot of people don't want to accept the fact that, hey, technically gold and silver are in a bear market and the dollar is in a bull market. That is not going to bode well for precious metal investors at the moment. It's going to be a great opportunity to get into precious metals and miners down the road. It's going to be a fabulous opportunity that I can't wait for. But right now, you do not want to stay on a sinking ship at this point.
How long do you anticipate this lasting, this final washout in the metals before we form a new uptrend?
Yeah, that's really tough. I mean, we can look at the monthly chart of gold. You can see how it goes through these sequences. You can have a huge run, then it can go dormant for decades. Again, we had another big run through 2000, peaked in 2011, and then it went dormant for 15 years before it really broke out and started to run again. And here we are again at another one of these big peak phases, right? It's like, if you go and you look at these giant, turning points in the markets where it has these huge rallies, we are back into another one. So
the market's biggest opportunities usually emerge only after investors stop believing they exist. Chris Vermeulen's argument suggests today's bearish trends may ultimately create tomorrow's strongest accumulation window, but timing remains everything. Many investors become emotionally attached to assets instead of objectively following long-term market structure. Capital preserved during major declines is often the capital deployed most effectively later. Next, Chris Vermeulen reveals why history, warns that recoveries sometimes take far longer than investors expect.
So the big question is, which is what you're asking, is like, how long is this going to take? And that's kind of the concern, right? We don't know if it's going to take 2 months or a month and just wash out and turn around and take off, or if it's going to do a lot like what it did in 2011, 2012. Maybe it trades sideways and holds up, and then eventually it kind of has a breakdown and it just sells off for several years and builds a rounding formation, just like what the dollar is doing. So this could sell off and struggle for a while and eventually put in its new launch pad and then work its way up to 8,000, 12,000 and all of that. Again, long term, I'm extremely bullish on precious metals, but I do think there's still quite a bit more downside. And the biggest concern to me is actually this blue box right here. This is like, a 10-year, 15-year window of no return. And that could happen again. I doubt it, but it could take several years still. And the last thing you want to do is, have your money just sitting there not working for you. It needs to be working for us with inflation and everything going on. You got to make sure it's protected, number one. And number two, it's working for you in some asset class, right? If precious metals aren't favorable, you've got to go somewhere else temporarily. And then you can go back into precious metals when they become favorable and start that next major leg up.
Time can quietly destroy portfolios, even when prices eventually recover. This is where Chris Vermeulen's thesis shifts toward opportunity cost, arguing that stagnant capital carries its own hidden risk during prolonged consolidation. Institutions continuously reallocate assets rather than waiting years for dormant positions to revive. Successful investors protect purchasing power by remaining flexible instead of emotionally committed.